have the new. We're doing Tech Teardown for Friday, December 13th. Let's get right to headlines. Despite some of the inventory shortages at launch, Apple's iPhone 5S appears to be faring quite well. Investors now have some new data suggesting that the 5S is the top smartphone, both domestically and abroad. Tell us more about it.
So a couple different data points. First is the Canaccord Genuity coming out with a research note saying that the iPhone 5S continues to be the top model across all 4 domestic carriers. In addition, that's also for 3 months running. That's September, October, and November. The other 2 spots are kind of being traded off by Apple's iPhone 5C as well as Samsung's Galaxy S4. So the GS4 is still doing pretty well, even though that was launched, in earlier April, May of this year. On the international front, Counterpoint Research says that the iPhone 5S is the top model globally in October. And also Apple's just really solidifying its position in Japan.
So you mentioned Counterpoint Research. They actually had some specific information about China.
Right, they did, Aaron. So when we talk about the Chinese smartphone market, we've been hearing a lot about Xiaomi and its rise, and Samsung is still the market leader there. But we're seeing right now, Apple has made a really big jump from September to October. In September, they're the number 6 vendor. In October, they're number 3, which is really probably the best position they've been in probably ever. So it's a pretty nice little jump there with the launch of the 5S, and with the China Mobile deal even imminent, expected, maybe even as early as next week. Counterpoint even expects that Apple could go on to become the number 1 vendor in China, which is kind of a crazy thing to think about.
So lots of international success in the cards.
Oh yeah, especially if since China Mobile is going to be subsidized, and we've seen some leaked documents suggesting what their prices, their subsidized prices will be, they could start a little bit of a pricing war between the 3 carriers, and obviously Apple wins from that.
Right. In September 2012, Apple shares peaked at all-time highs around $705. We all know what's happened since, a long, painful decline. One analyst is now suggesting Apple can reclaim its former glory.
So Evercore Partners is coming out and boosting its price target from $630 to $700, pretty close to that $705 high that we hit some time ago. They're kind of bullish on the product refreshes that have happened in the past month, reinvigorating some of the momentum for demand. Also see iPad unit growth accelerating next year to about 16% compared to this year's expected come in around 11%. Also going to be some gross margin stabilization since over the past year Apple took a lot of kind of preemptive conservative hits with gross margin. Warranty expenses, depreciation expenses, we had some deferrals of revenue that were kind of holding back, so I think we have some tailwinds to some further gross margin upside going forward.
So Evercore doesn't have the highest price target on the street. Who does?
So Brian White has been one of the widely followed Apple analysts for quite some time. He's kind of moved between firms over the years, but it's almost as if he had this thing like, I'm going to have the highest price target on the street. So right now he's still at...
Do you think he even believes in his price target, or is he just trying to make a point?
He has these really crazy numbers too. So right now his is 777. Which is higher than 700, but he's also the same analyst that over the years has had the 1111 price target, the 888, like these really kind of weird numbers.
Is he just gimmicky? Like
did you do discounted cash flow to get it these very?
Yeah, to get exactly $888.
So yeah, they're kind of odd, but he was out earlier this month, kind of reiterating his 777, saying he's also the one that keeps track of Apple suppliers using what he calls like the Apple barometer, and that suggests a lot of healthy activity in the supply chain. So he's still bullish, but he still gets to claim the title of highest target on the street.
So between the 700 and the 777, where do you see Apple going?
Well, I think that one of the, if we look at Apple's valuation, if we were to even there's a lot of ways we can get there, right? I mean, if we were to just assign Apple a market multiple of around, right now the S&P 500 is trading about 19 times earnings.
Which is a little expensive.
Right, I mean, if we give Apple just that same multiple, that puts it at $750. Now, as far as getting that multiple is certainly easier said than done, but some of that comes back to sentiment improving, which can be like gross margin stabilization that we've talked about, possible new product categories, just all these things that maybe if investor sentiment can improve, maybe you can get that multiple back up to where it needs to be, even without talking about continued revenue growth and profit growth, just as far as sentiment.
All right. Bloomberg is reporting that Google is looking to get into chip design, possibly making processors for its own servers. Why? Why would Google do that? What's the point?
Well, the name of the game here is really just vertical integration. And since Google is an online services company, that integration comes in the form of data centers. And it already makes its own data centers, but kind of the heart of the data center is going to be the processor. So I think the idea here is that if it can really tailor its processors around, it can integrate hardware and services better, have more control over it. Reportedly, it's going to be doing an ARM-based chip, so there could be some also power efficiency gains. So there are a lot of reasons that this could, there's reasons for and against.
Well, Google's never made chips before. Like, how feasible is this technically?
So Google, as far as we know, Google doesn't have any experience with making chips, so I think that even if this happens, which is in the report is very clear that this might not ever happen, it's still kind of just a conversation that's happening. Still seems like if it is going to happen, it's going to be a way off, because if they're going to be using ARM chips, they don't have the experience, the knowledge, or the architecture, the instruction set license from ARM to do like a full-on custom chip, which was some of the other players have been doing. It's a little bit more realistic for them to implement in a kind of off-the-shelf ARM core, but even then, 64-bit Cortex A53s and A57s don't ship until late 2014. So even if they do that, it's still going to be a little bit away, if at all.
Okay, so Google currently buys its server chips from Intel. Should Intel investors be worried about this?
A little bit. Intel's data center business is their most profitable right now, so any negative storylines there are something for investors to keep an eye on. Bloomberg estimates that Google is Intel's 5th largest customer and at about 4% of revenue. So if that business theoretically goes away or declines in the long run, definitely something negative for Intel investors.
There's a stir in the C-suite at mobile chip giant Qualcomm. The company announced new CEO on Friday morning, Stephen Mollenkopf, effective in March. Who is this guy?
So Mollenkopf has been at Qualcomm for almost 20 years. Of that, he's been CEO since November 2011. So he's been around. He knows the business very well. So I think he's kind of a natural fit. Current CEO Paul Jacobs is stepping down. He was the son of the co-founder, but he'll be stepping down and becoming executive chairman. But he'll also still have a pretty firm grasp on strategic direction and really help guide the company. Mollenkopf, one of the big things that he did was he really helped lead the acquisition of Atheros, which is about $3.1 billion, which is Qualcomm's largest to date.
So Steve Mollenkopf, he'd also been one of the names tossed around to be replacing Steve Ballmer at Microsoft. Do you think that had any influence on this move? It's
possible, because it's very likely that Qualcomm board was already kind of looking at this transition and promotion, but with all the talk about Mollenkopf being in the running, it's possible that kind of forced their hand. Like, okay, let's go ahead and make him CEO because we don't want to lose him, because that's definitely not a guy you want to lose to a big company like Microsoft when you need a new leadership.
Shares of Adobe have soared over 10% after the company reported earnings, despite guidance coming in below expectations. What are investors so excited about?
So the real story here is all about the continued shift to a cloud subscription model. Right now, let's see, they had a sequential increase in Creative Cloud subscribers of about 400,000, which is up sequentially from, that's a sequential gain, and they're at about just over 1.4 million subscribers total. So I think those are all really coming in better than expectations, so investors are pretty pleased. There was some concern last year about the shift to a subscription model, so I think they're really kind of silencing the skeptics.
So you mentioned the subscription model. That's obviously key for Adobe here. A lot of companies are shifting to that now. Do you like this model?
I think it's definitely the right thing to do. Like you said, other companies are doing it. Microsoft's doing it with Office, Office 365's subscription model. I think companies like to do it now because it gives a little bit more of visibility into their business.
Recurring revenue.
Right, it's more recurring revenue. A lot of things to kind of look forward to. Initially there were some complaints from some of the professional users when they heard about Adobe making this shift because they want to just pay. Photoshop is expensive.
Really expensive.
But they just want to pay it up front and then be done with it.
Right.
And the whole idea of having to pay on and on, some of them didn't like that. So that's kind of where some of the skepticism came from. But Adobe's showing that right now that they can actually make this work. And you could actually even gain customers this way because that $600 or $700 price tag for Photoshop is kind of a high bar.
Do you think part of it is that Photoshop is just it's almost a best-in-class product? Like, users don't have a lot of other options.
Oh, it absolutely is. It's the standard, and there's really no rivals that can really take the leadership away from them at this point. And they do have that pricing power, and they've really established themselves in this creative market. But they can even grow new users next. Now there's low upfront costs. Instead of having to pay $700 to $800 for this program, you can just pay $50 a month, and kind of lowers the upfront bar. But I think they're really making this shift quite well.
For Evan New, I'm Erin Kennedy, and we'll see you next time.